My name is Mitch Cook. I'm a retirement plan advisor here at Excel Wealth Management, and we're happy for you guys to join our webinar today. What you don't know, common financial misconceptions. I have Tony Gafe with us today, who's one of our senior wealth advisors. And one of the biggest things that we look at when we look at common financial misconceptions is just really having a good understanding of where that's coming from. And with Tony's background as a CFP, he's definitely had quite a bit of an experience when it comes down to conversations around this. And a really big part of really the webinar today is it comes down to being educated. And this is really going to be an important part to not only help you today, but really for that financial future that you would have planned for yourself. Before we go through the presentation, if you do have any questions, definitely use the Q&A box at the top of your screen. Ask your questions in there. We will hold off until the end before answering any of your questions. We're definitely going to hit on a handful of those common financial misconceptions, but if there is something where you might be confused on or maybe want some additional clarity, that's really where we're here to help you with. As always, this is for education purposes only. We are not tax or legal advisors, but we do work in a fiduciary capacity. So our job is to definitely help you in your own personal situation. So what do you think of when finances come to your mind, especially from a personal finance? So what tends to come up? Saving. I mean, those are some of the things that immediately come out of that mind. Buying a house, debt, maybe protection, Social Security, depending on where you're at in your lifestyle or in your life phase, and of course, retirement. These are some of the biggest things that most individuals and households may have over the years that come to mind. The biggest part we look at is what are some of those misunderstandings when it comes to those finances? And a lot of times those financial misconceptions, depending on what kind of information you receive, it can restrict you and really restrict you on potentially having better success for that financial planning, but it could potentially create unnecessary risk. And that's where having being better educated, having somebody provide that trusted advice, those are going to be some of the key things to have early on to be putting yourself in a better position as well as your family. Over the next slides, we're going to hit on some of those, like I said, some of those common financial misconceptions that whether it's as an individual or as a household, some of these may apply to you today, or you may think, those are definitely some areas that you could easily get cleaned up. So let's kind of get started here. Probably one of the biggest ones that's really started to come up in the conversation, especially with rising interest rates, and we're hearing it more often, is a 30-year mortgage is cheaper and costs me less. So Tony, how do you help clients have a better financial understanding about this misconception?
Yeah, absolutely. The concept between cheaper is relative to what you overall pay. So a comparable would be if you had a 30-year or a 15-year mortgage for the same amount of money, the 30 years just stretching it out over a longer period of time. So in the moment, month to month, it's less of a cost, but overall, you end up paying a lot more in terms of overall interest. So when I talk to people about mortgages, and it could be a car mortgage, it could even be an auto loan, when you look at what is it that you're paying for your monthly amount, you got to factor in what's called an amortization table to figure out what's it actually going to cost you. So, for example, if you have a $100,000 mortgage, and I looked up the local credit union rates right now, and a 30-year is about 6.25%. So on $100,000 at 6.25% for 30-year mortgage, you're looking at a payment a little over $615. So you say, okay, that's affordable. It's within your budget. No problem. But that $100,000 is actually going to cost you over that 30-year period $221,000 and change, a little bit more than $221,000. So you're taking out and borrowing $100,000. You're effectively paying that back, but on top of that, you're paying another about $121,000 in interest. So you're paying back more than what you borrowed, uh, double some basically. If you look at changing those numbers on an amortization table and you go with a 15-year loan, everything else remains the same. $100,000 at 6.25%. All you're doing is changing the time on it. Your payments change from that $615 to about $857. So you're adding on 240, 250, somewhere in that range of extra into your monthly budget. But the big kicker is the savings you have on interest. So as opposed to paying $121,000 in interest with the 30-year, the 15-year, you're paying a little over $54,000 of interest. And that's really what surprises people when I go through and discuss with them looking at mortgages. We run through an amortization table and we look at the actual numbers. You may end up paying more in interest than principal with a 30-year mortgage. In that circumstance, with the 30-year mortgage, roughly $100 or so is going to principal. The remaining $520 is going to interest. So that's something that you really need to consider. So when rates are at 5% or above, you typically end up with a 30-year mortgage paying more in interest than you did in principal over the life of the loan. So you look at a monthly lower cost comes at the expense of long-term wealth. That's why we have it as a bullet point here. So if you can take your mortgage and shorten it, those are going to be some of the best practices to get around this misconception. So consider a 15-year mortgage or consider making additional monthly principal payments to shorten the time that you're paying that interest. It also works with auto loans. You might say if you're going in and you have a certain budget, well, okay, we'll give you a 7-year or an 8-year auto loan period of time instead of a 4 or 5-year. Well, it makes the monthly payment come down, but you really need to run the numbers, Mitch, on how much interest it actually costs you over that period of time. So always keep your ear to the ground in terms of refinance rates or anything along those lines. So if you can refinance at a lower rate, great, but a lot of that's going to be dependent upon what the Fed does with interest rates.
One of the other parts to this conversation, Tony, is those that have gotten really good interest rates. The 3.5% or lower, depending on what it is. And, what kind of conversations are you having with individuals that are thinking, I just want to pay down my debt as fast as I possibly can, and they
Sure.
have one of those low interest rates?
Yeah, it's a good question. It comes down to the numbers. If you have a 2 or 3% interest rate and you've got cash in a CD making 5, well, the numbers say keep the money in the CD. You collect the 2% difference as profit to you. Taxes might come into play a little bit on that to reduce that 2%, but overall, you're better off from a financial standpoint. But what I do run into with clients from time to time is that money is a emotional thing. It can cause you great stress. So if you look at it and say, okay, I'm going to cash out a portion of an IRA account or a 401k to pay down my mortgage, you're going to pay a lot of taxes typically if it's not a Roth option on cashing that money out. Well, financially, that may not be the best thing to do on paper when you pen out all the numbers. However, emotionally, if your stress level is very high because you're carrying that mortgage debt, maybe it's worth that extra money. Maybe it's worth the taxes. Maybe it's worth a couple hundred or a couple $1,000s to take that stress off your plate. So that's really a situation, a scenario. Should I pay off my mortgage or not? I don't know. It depends on you as the individual, and it also depends on the conversation you have, hopefully with a financial planner, to look at the pros and cons of that.
Perfect. All right. You know, I think we've heard over the years, and many individuals and households have the belief having
Mhm.
$1 million is enough for retirement savings. Once I get to the million, that's kind of the magic number. I mean, tell us why is this kind of a misconception, Tony?
It all depends on your budget. If you're going to go out back and go fishing in the pond that you have out back, and that's all that you're going to do, you're going to dig up worms out of the ground. You don't need much money to do that. You may not even need $1 million, but if you're going to go down to the Lake of the Ozarks, get a big cigarette boat, and cruise around all day long, you're going to burn through a whole heck of a lot of gas, and it's not cheap to do that type of thing. So the $1 million, it's good to have a goal, have a stretch goal, but you shouldn't feel like you haven't achieved what you need to achieve in retirement if you didn't hit the $1 million, if you don't expect to have big expenses. But if you said, well, I want to retire very comfortably, I want to keep the lifestyle I have, you got to factor in, well, is $1 million going to do it? And then you also have to factor in, how are you going to manage that $1 million? A lot of people will say, I'm going to have it in the stock market. It has growth. And that's great long-term plan. But there's a lot of factors that can disrupt the stock market. It can make that $1 million less, just as much as it can make it more. And if you're taking money out during that period of time, you can do extra damage to your portfolio. So it is a misconception to say, if I hit the $1 million mark, that's it, I'm done, I don't have to save anymore. That's not necessarily the case. You really need to put together a plan. So we look at all these factors when we're putting plans into place, as to how the market's going to affect you, how you're going to take money out, where you're going to take it from. We put together a slide here that Mitch is going to go through, called the sequence of returns, a tale of two brothers. So what the tale of two brothers is we have two scenarios in which these individuals, John and Steve, made up. They each have $500,000, and they're going to, over the next 10 years, take out $30,000. Well, what we did was we said, okay, what if that $500,000 was put into the S&P 500, and we look at the returns over a 10-year period of time? Now, the difference is we have the 10-year period of time for John starting in 1990, and we have Steve starting in 2000. Again, starting with the same amount of money, taking out the same amount of withdrawal. So for John, we're looking at the sequence of how the S&P 500 performed, with $30,000 being withdrawn out of that portfolio, and then the remaining money left to grow. At the end of the 10-year period of time, from 1990 to 1999, John he started with $500,000, took his 30 grand out, ended up with, as you can see on the chart, 1.2 million. You take the exact same scenario, but you move it a decade later, starting in 2000. And we look at what happened with Steve. He again starts with $500,000, takes out 30,000 a year. However, at the end of that 10-year period of time, he's got $96,000. They executed the exact same strategy, but timing wise, the S&P 500 did better from 1990 to 99 in that strategy versus 2000 to 2009. So you have to be very careful with how you withdraw money. $1 million may be enough, it may not be enough, but you also have to look at, how are you going to draw down that money? Do you have different types of assets that you can draw from? You may have some market assets. You may have some market protected assets. So when the stock market is not doing well, you have a different pool to be able to pull money from to live off of. Retirement is really about cash flow and having the money that you need to live the lifestyle you want to live. So that's why we say it's a common misconception to say $1 million is enough. Maybe, maybe not. You really should not just gauge on a arbitrary number. You should really put together a more comprehensive plan.
Which kind of leads us into, as you mentioned, market protected assets. I mean, there's definitely a lot of ways to do that. This next common misconception does have some of that as a component of it, but a lot of people have a belief out there that life insurance is expensive and it doesn't benefit me. And so, really, looking at that and what that means, Tony, when those comments come up.
Yeah, so there's kind of two misconceptions in here. One is the expense of life insurance, and two, that it doesn't benefit you. Um, it depends on the type of life insurance, the expense, and we'll go through in some further slides to show the people watching what we mean. Now, the part where it says it doesn't benefit me, somewhat true, because in order for life insurance to pay out, you're deceased. So you're right. It doesn't benefit you directly, but it may benefit your family, which kind of indirectly is benefiting you. Things that people look at insurance for, a lot of times they'll say, life insurance, I don't want it. I'm gone and somebody else gets the money. But it is a way to take typically a smaller amount of money, turn it into a larger amount of money, and make it tax free. Now, some of the reasons why you might want to consider the benefits to you, or I should say to your family, is replacement of income lost if you were to pass away, or education for children, or paying off a mortgage. You really look at the benefit of life insurance is if I pass away, who is going to be financially hurt by that? And can I plan to make it a little bit easier? So one of the things that impacts life insurance expense is health, and the other is age. So the less healthy you are and the older you get, typically that's going to cost more for life insurance. There is a type of life insurance called term life insurance. It's designed to be one of the more affordable options outside of maybe a group plan if you have that through work. But the term life insurance is portable with you. So even if you're covered at work with life insurance, if you no longer work at that company, a lot of times that life insurance stops at that point. A separate term life policy can be transported throughout life as long as the policy is active to wherever you're at and whatever you're doing. Now, the idea behind term life is that you're insuring yourself for a set period of time, 10 years, 15, 20, 30. So it's really designed almost like a warranty on yourself. It's not really there to be an estate planning tool. Hey, I'm going to leave money when I die to charity, or I want to, leave money for my family. It's really more of an emergency type version of insurance that if I die before I've had time in life to accumulate other assets, I want to make sure that those I care about, or whether it's a person or a charitable organization, have some sort of tax-free payment as a result. It's designed, again, to protect your loved ones, could be used for burial purposes, but it's really designed to say a set period of time, I'm going to be impacted financially. How do I cover that? So in this example here, and again, it's all based on health rating and age, so it will vary. We're not saying everybody can get a $500,000 20-year term life, but just as an example, a female with decent health that's 30 years old can get $500,000 of coverage for a little over $214. A male, same age, 30 years old, again, similar health, good health, you're looking at maybe $275. Don't take those numbers as written in stone. Again, insurance carriers change their rates. Insurance has to go through an underwriting process to determine your level of health and what grade they give you in terms of your standard rating or more preferred rating or less than standard. But this just gives you an idea that if you're young and in pretty good health, you can get a sizable amount of life insurance for a fairly affordable rate. You're also not locked in. Even though the term insurance options, usually 10, 20, 30 years, that type of thing, if you get a 30-year policy and in year 18, you've accumulated enough assets that whatever that term policy was covering isn't needed anymore, you've got enough assets to cover whatever it is you're covering, or you paid off your mortgage, or you did all the educate, you covered everything. You could just drop the insurance. You can stop paying for it, or you could reduce down the amount. So you can stop at any time. You can reduce, as we've got on here, reduce the death benefit. Now, if you try to increase the death benefit, the insurance company is going to scratch their head and say, wait a minute here, why are you doing that? We need to maybe run some additional health questions and that type of thing. And there are also additional riders that you can have on there. You can have early payout if you get chronic illness. You can have child rider, protect children in the event of an untimely death of a child. So there are different ways to structure it. It's just you want to go through and look at the options if you are considering, hey, I need to protect those around me. If you're single, a lot of times people don't even consider this because you say, if I'm gone, whatever assets I have will be divided up among the family. We usually see term life insurance happen when people get married or they have kids, or sometimes business owners will take it out as a way, as a cross sell agreement with the business. If there's concern that you've got two business owners and one of them passes away, well, what happens to that half of the business? How does the other person buy that half out? So you can structure a term life to cover all kinds of different types of protections that you might need in place.
Tony, there's a couple things here. Number one, especially for those that buy a house, a lot of times the banks, will incorporate and say, hey, this is, a life insurance policy and add to it. When we're meeting with individuals and they share this with you and say, oh yeah, we're covered with the term life. Can you kind of share a little bit about that? And then also, there's kind of a general rule of thumb on how much term life should I have?
Yeah, it's the term life. Let me just cover that because I want to keep us on track with time and everything. The what you need to determine is a budget of who or what would be hurt and how much would it cost to fix it. So you would factor in terms of determining the amount. What is it that you're trying to protect? What is it that you're trying to cover? Do you have a lot of debt, either credit cards or auto loans or home loans? Do you have children that are going to have education needs down the road? Well, you want to estimate how much that's going to cost. You also want to look at loss of income. If you're married and your spouse passes away, and you have kids especially, who's going to take care of the kids? Do you need to now have nanny services or childcare services or some other type of help so that you can continue in your job, but also have help with the kids? So you want to factor all of that in and then typically add a little bit to it for inflation purposes. You buy a 30-year policy and say, okay, $200,000 will cover me today. But 30 years from now, $200,000 with inflation isn't going to buy the same goods or services that it does today. So you do want to give yourself a little bit of an inflation hedge there.
Yeah, I believe the number is about 10 to 15 times your salary income. But again, all those factors definitely play in. All right, this is a pretty big one. And I think a lot of people definitely been on their mind, especially those that are closing to retirement. Social Security is going broke and it won't exist when I retire.
Yes. So we get this question quite a bit. And what people look at with Social Security is that you're not getting necessarily your own money back. Other people are paying once you turn on Social Security for your current benefit. So the Social Security system was built upon a premise of having kind of a sovereign fund or a cash fund. And then along with that, there is the current income or taxation on that income that's coming in from workers that pay the current benefit. So me working now, I'm not on Social Security, but I'm paying, for example, for my parents' Social Security benefit who are on Social Security. And when people look at Social Security is going broke, part of it is that the Social Security Administration, they used to send out paper statements. They kind of changed that and have reduced how often they send it out, and they prefer you go online. But they've had a caveat in there, a little line item that says, hey, unless something changes with the tax laws or the way Social Security is built, we're going to run out of money of that sovereign fund, and we're only going to be supported by current workers' Social Security payments that come into the system. The Social Security Trust Fund was updated and reassessed, and the Social Security Administration, I believe it was in June of 2025, released information that sovereign fund is projected to not last as long as they thought. It's now moved to 1 year sooner. So they project that pile of cash to be depleted by 2033. And at that point, again, all things being the same as they are now, Social Security benefits are only going to be supported at the level of about 77%. So you could see a fairly sizable shift down or reduction in Social Security benefits if nothing's done to change the system. Now, I would imagine that the Social Security Administration's looking at this. That's why they put out that little caveat. It's been in Social Security statements for decades saying, hey, look, this is a problem, but it's a touchy political situation. Anybody even mentions changing Social Security and alarm bells go off and red flags go up. But if you just look at what's happening to the population here in the country, there were more workers back in 1945 supporting fewer beneficiaries. There were more workers than beneficiaries. Well, as the baby boomer population, helped build up that Social Security sovereign fund on the back end, they're helping to drain it as well, taking that benefit, that they helped build up. Now we're in a situation where we've got more people on Social Security, and aging population on Social Security that's using those benefits. At the same time, medical advances are pushing life expectancies much further than when Social Security was created in the first place. So I don't think the common misconception is it's going broke and it won't exist. Going broke, not really, because there is the funding from current workers. It won't exist when I retire. Probably will. I just don't know what form it'll be in. If we keep it the way it is now, it'll just be a massive reduction in benefit. But I suspect, I hope, somewhere in the next 10 years here, we get some political muster to actually fix the problem and not wait for the precipice at 2033 and, to go over the cliff and have a reduction in benefits.
Tony, when you're doing your planning process for individuals and households, how much are you looking at if your replacement is trying to get to, 70, 80% of what their income is today because they don't have as much debts? How much of that replacement are you looking at is coming from Social Security now? Because obviously it's changed over the last decade.
Yeah, it depends on the individual. I mean, if you haven't put extra money away for retirement and Social Security is all you got, that's all you got. But when we're planning, hopefully we're not planning, for an individual right as they retire to say, okay, I haven't saved enough money. How are we going to make this work? Hopefully the planning process comes in a bit earlier than that so we can put strategies in place to help supplement. Social Security was originally created as an extra. The assumption was as your job will provide a pension, you're going to have some savings on the side, and Social Security is a little extra on top to help the bumps in the road or the unexpected expenses that might come up. Whereas now, with a lot of pensions going away or not being available to the workforce, really have to rely on your retirement plans and the strategies you put in place during your working years. So I do look at that. We look at, do you need to turn it on when you can at 62, the earliest you can turn it on? Do you wait until 70 because the benefit will be longer or greater? It all depends on life expectancy. It depends on if you're married or not. Do we need to have a higher benefit or not for your spouse if you were to pass away? Those are all things that go into it. So there isn't enough time on this webinar to go through all the various nuances, but I would say it's important to define what you want to have happen with Social Security earlier than later so that you know kind of what you need to do in life for other savings to supplement that cash flow and income in retirement.
Couldn't have been a better segue, Tony. I mean, we do meet with a lot of individuals, late 40s, early 50s, and this seems to be a key part of that conversation, especially if they really have it set aside and there is that concern with that other income flow. We get the comment, it's too late for me to save. Why? Why should I do it?
It is a misconception. It's never too late to save. I know that might sound cliche, but the government has put in place measures to allow you to save more. If you didn't save for whatever reason in your 20s, 30s, and 40s, once you hit around 50, there are some additional options. You've got catch-up provisions on IRA accounts. You've got catch-up provisions that are in place on workplace retirement plans. So it's not that it's too late to save. It's just you might have to save more money. You might have to impact your current lifestyle if you wait until your 50s and 60s to actually start savings. But the idea, if you do wait, is that maybe these are your highest earning years. This may be where you have your highest salary or the most overtime or whatever it is that provides more income. Maybe your other debts are paid off, so now you can focus more on savings. That's why those catch-up provisions are in place, is to give you, the ability to put the money away to help compound for a longer life expectancy. If you plan to live to be 80 to 100, if that's how your genes are, then, even starting in your 50s or 60s, you still have another 30 years, 40 years for that money to continue to grow and produce income for you. So again, it's never too late to save. We actually have on our next slide an example, though, of why it makes sense to consider saving earlier. We've got three individuals here, Michael, Ashley, and Courtney. And where the differences are, they both are saving 50, or all three of them are saving $57.69 a week. All three of them get the exact same growth rate on that money at 7%. The difference is when do you start saving and for how long? So in Michael's case, he starts saving at 35. Ashley starts at 21. Courtney starts at 21. Michael's going to save for 32 years. Ashley's going to save for just 14 years. And Courtney saves for 46 years. So you can kind of see how this is going. Courtney is probably going to win the race here because she's starting to save early and she's saving for a long time. But if you look at the slide, you can see how the math plays out. The biggest difference is Michael and Ashley. Ashley is going to save earlier in life, but for less years than Michael. And she ends up with, at age 67, almost double the amount that Michael had. So it's not too late to save for Michael. He shouldn't say, hey, look, I don't have the power of compounding because I waited too long. That's true. Your power of compounding is going to be less effective because you're going to have that money growing for less period of time from when you put it in. But mathematically, you can see here that it's still not too late. You start saving the 57.69 a week, even though you're saving for 32 years for a longer period of time, you still end up with 342,000. Courtney, of course, at the end wins that race again, starting early and contributing for a long period of time. But that's the power of compounding. That's why it makes sense to save early. But also, again, in the case of Michael, misconception is he's not out of the race. He just has to do a lot more catching up to put away a nest egg.
Even though that we didn't get into, the how you save, whether it's pre-tax, Roth, and after tax, those particular elements have a big impact in each one of these scenarios too, which is another conversation for another day. But it's having all these things coordinated together.
Right.
This is our last misconception for the day. I mean, there's definitely a lot more, but I think this could be one of the most important ones to fully understand is trusts are only for the ultra wealthy.
Yeah, it is a common misconception. It's something I do get a lot of questions on. The more wealth you have, in theory, the more complex your finances might be, and a trust may be helpful for that purpose. But a trust allows you to have your assets controlled from typically beyond the grave. That's usually why somebody sets up a trust, is so when they pass away, there is some set of rules and some set of boundaries put in place on the assets that they're going to leave behind. But that doesn't mean it has to be for the ultra wealthy. One of the reasons why people look at a trust is to simplify their estate plan, to keep monies from being judged in probate and going maybe to areas they don't want it to go. You can also put in provisions in a trust to say, well, I only want a little bit of money to go to my kids every 10 years. That way it stretches it out. I don't want them to buy Corvettes and hot tubs with one big lump sum when I pass away. It helps you to avoid those things. One of the biggest reasons why people consider a trust is, especially if they don't have large, complicated wealth assets, is if I pass away, I don't want my kids to fight amongst themselves over what was left. If I put a trust in place, it is basically written in stone. This is what's going to happen with the money. It's not contestable. Okay, the estate has to be paid out this way. If the kids don't like it, then they can be mad at me and I'm gone, or they can be mad at that piece of paper, the trust, but hopefully they're not going to be mad at each other. They may not like the results. It may to them sound unfair. And where that might come in is if you've got multiple siblings and one of them was able to spend more time with their folks than the other, they might say, well, then I deserve more of the inheritance. Well, if the parents say, you know what, we're doing it 50-50, or however you're dividing up, however many siblings, the trust just makes sure that that happens. And again, if somebody's been out of shape about it, there's only so much you can do. But the idea behind a trust in that case is to try to keep the family unit together, keep people being friendly, keep people being cordial, keep people talking. Other times it's a way to, we see it with farm ground, for example, or any kind of ground. But farm ground especially, let's say you've got 3 kids, one of them wants to keep the ground and farm it, the other 2 do not. Do you sell off 2/3 of the farm when you pass away? How are there provisions in there that the person who wants to keep the land gets to keep the land, everybody else maybe gets the other assets, or they get a portion of the rent? Trusts really help to define that and keep things civil among folks that inherit assets.
Absolutely. And, of course, living in Iowa, the farmland, the agricultural land, I know one of the things that we've seen in trust, especially, if it gets passed to siblings, well, what if one of the siblings isn't as financially responsible? You can set parameters within that trust. And what if one of the siblings is going through bankruptcy? Do you want to sell their portion of that land or whatever is identified in the trust as real estate at a premium? A lot of trust will have clauses in there that is then discounted, so then it doesn't have that big of an impact for the purpose that it's just paying off creditors. So there's definitely a lot of things that a trust can help out with, more than just for the ultra wealthy.
And then the thing is, a trust can be as complex as you want it to be, as complex as you want to make it. It doesn't have to be super complex. And it's really just, do you want to have those rules and guidelines for your estate in the future? Maybe it's worth the cost to set up the trust so that you have, again, peace of mind yourself that your assets will be handled how you want it to be handled.
Yeah. And I think one of the things which we didn't hit on, the blended families where you have second marriages and, the husband and wife have separate kids and they want to divide it, appropriately how they want to have it divided. Again, a trust makes it a little bit more black and white, and it takes
Right.
the emotion out of an estate that's being dissolved. So,
Yeah.
I mean, I really think, and as I mentioned, the Q&A box is there. If you do have any other questions that you're thinking, I'm confused in this, I get conflicted information. Ultimately, it's being educated and getting that proper guidance, which gives you a better understanding, allows you to make those better decisions, and it gives you typically better outcomes. And so, meeting with a financial advisor, having those conversations, Tony being a CFP, including those other financial elements. As I mentioned in the beginning, while we're not tax and legal advisors, everything that comes down to any kind of financial aspect is going to have taxation included in it. So it's really offering that clarity that you may need.
Absolutely. Yeah, education is very important. If you find it online, if you find conflicting things, check with a financial advisor to help set things straight.
Yes. So our next webinar series is this next month. It's on credit score, why it matters. I know we talked about, mortgage rates. There is a lot of things that go into how your credit score is. and making sure that that's up to date. That's here this next month. Definitely a great opportunity to join. If you did miss any of our webinar series, we did have a specific webinar series earlier this year that was on Estate 201 that did get into the trust aspect as well. You can always go back, listen through that, or again, this is an opportunity to meet with one of our advisors or connect with your financial advisor and kind of go through some of those questions that you may have.